partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn is nice enough to come on and talk about what's going on in the marketplace because he's from Hackett Financial in Boca Raton, Florida, where I understand they are building arcs to send people down the river. Am I pretty close on that?
Yes. They're sold out. It's a booming business right now, given the 22.5 inches of rain Fort Lauderdale Airport received yesterday in 8 hours time. They actually closed the airport for 6 hours. Anyone that knows Fort Lauderdale knows that even during Category 2 hurricanes, they typically don't even close it. So quite a rain event. Here in Boca, it was not quite as bad, and we have better drainage, but pretty amazing. We had some kind of a sloppy upper atmospheric stationary low that just wouldn't go away. It's gone now, but been down here since 1999, and it's about the most intense rainfall I've seen. And through all the hurricanes and tropical storms and depressions, about the most intense rainfall I've ever seen. So
That's a fair amount of rain, Shawn. I'm not gonna lie to you.
it's a fair amount of rain. Yeah, that'll solve most water problems. And
I feel like any place that got 22 inches of rain would be hemmed up for a while, but it is Florida and it is a tropical environment down there. So you guys are going to have.
Just think, if you use the 10 or 12 to 1 ratio for snow, that's like getting almost 300 inches of snow in 8 hours.
Yeah. A few roofs might have collapsed, but no big deal. Easy.
So
Easy
fortunately, it was not snow, and the rain definitely goes away. So
Right on. Right on. All right. Well, glad you survived that. That's that's a good deal for you. So, all right, Shawn, let's talk about something here. We have been bantering back and forth on the milk market here for a while, and last time we talked about milk had made a run up from the mid 17s up to just a little bit over 20, and you relayed that back to a glitch in the what was it called, that report, the traders intentions report, that there was a glitch in that system that was causing no one really knew what was going on, so everybody got it figured out, and all of a sudden, boom, took off and ran. Now, subsequently, about a week and a half later, it comes back down, settles into that 1750 range again. Now it's blowing back up, but today I'm looking at it right now, it's 1875 right now in the overnights before the open here. So I guess, Shawn, what's going on in the milk market? There's a lot of volatility there right now.
Well, three things. First, remember that the sentiment in the milk market is extremely bearish because the milk market is driven by Chinese demand, and Chinese demand has been terrible here in the first quarter because of their COVID chaos period and not buying a lot of milk and that sort of thing. And so it's, everyone's bearish. Having said that, because of the historic flooding out in California, because of this, now we're starting to see the snowpack melt. That's terrible for dairy out in California. It's terrible for cow stress, which means lower production. It's not good for feed quality, which means lower production. And there's no end in sight to that situation. I mean, that snowpack melt's going to keep on giving extreme flooding for the foreseeable future in the next couple of months. So we got the monthly production report out for California. Well, it's for the whole country, but the California was down 3%. And California represents 20% of milk production. So then we had this crazy fire in Texas in one of the largest dairies in the country. I don't know the exact details of what happened, other than they were supposedly trucking manure, and there was a lot of static electricity, and somehow the whole thing blew up, and it blew up the entire facility. I mean, the whole thing is a zero, and they represented about 2.2% of U.S. production gone, not to return.
That's a market number.
So,
Yeah.
well, and top of the California, being down so much, and I mean, I'm not sure why people were surprised by that, Casey, but I've been talking about this in my reports for a while, that this is coming. So you all of a sudden you put this together, and everyone says, well, shoot, production that the production, U.S. production is not going to be anywhere near as good. And then, we know that dairy production follows the economy here and elsewhere. And so consumer sentiment readings came out of China, I think it was 3 or 4 days ago. And of course it had cratered during the first quarter, because everyone's, was scared, and everyone was getting sick, and everybody was dying, and whatever's going on there, right? But we saw a big spike in consumer sentiment in the last report coming from China, and consumer sentiment leads improved consumer behavior, consumer buying. Of course, that means better consumer demand for dairy. So those two reports combined, of significant knockdown in U.S. production out west, and this very unfortunate and sad situation with this complete destruction of this huge dairy in Texas, along with improved consumer sentiment numbers coming out of China, is taking some of this morbid bearish tone into the market, and bringing some buyers in who. What happens during these times, buyers live hand to mouth. They think that every price is going to keep going down, but the minute that they think that maybe the bottom is in, they all rush in to buy and get supplies bought for more than just in time. And we're starting to see that happen, and it's starting to, we're starting to see some nice price movements. And it's the first, we've been warning about a bottom turn here at the end of the first quarter as we moved into the second quarter, and it looks like that turn up might be happening exactly as when we've been kind of forecasting it would. So far so good on the idea that the second quarter we would crawl our way out of the hole and start to see some better pricing. So not out of the woods yet. Certainly the prices aren't exactly where producers need them to be, but it's a move in the right direction.
That makes sense. That makes sense. All right, let's talk about sugar for a minute. So sugar's had a pretty big spike here. If you're looking at where it's been at and where it's at now, and the reason I'm concerned about sugar right now is because we're planting sugar beets here this week, if not next week, and then it'll be full swing the week after next for sure. Looking at the price of sugar, right now we're trading about 24 cents, and if you look at where it's been, it's kind of hovered around 18 to 20 cents, and now we've seen this big spike up here over the last, I don't know, couple of weeks here, a fairly big jump up. So in sugar market, when you're looking at that, Shawn, what do you think? What do you see some of the driving factors there?
Well, I always talk about how important India is to the sugar trade. Mm-hmm. It's the swing. That them and Thailand are the swing factor, and their production was, they had okay weather last year. They had some, it wasn't perfect, but it was generally okay. People were expecting their crop to be around 36 million metric tons, which would have been solid. And some production numbers have backed off, not a lot, a couple of million metric tons, but they've, over the last few years, they've diverted 5 million metric tons of sugar for ethanol production in India. So now 5 million metric tons of that production that normally would have been available to the export market is now no longer available because it's being used for ethanol. So what's now being understood is that they need 36 to have their normal exports. If they fall short of 36, then they have to back off, and that's what they've done. They've backed off their export expectations and export quotas, and they pretty much said we're not really going to export much more than we already have, or very little. And of course, we're moving into El Nino this year and next, which means that the weather gets considerably worse for sugar production. So I guess the point here, Casey, is that if they, are only able to export, let's say 5 or 6 million metric tons with a fairly good crop of 34, with generally not too bad weather, and we move into a multi-year drought scenario where their production could be off, and we could be looking at sub 30 million metric ton at a time that we're already in deficit. You have yourself a pretty nasty situation developing. And so, the sugar market, after almost 2 years of basing, as you said, between 18 and 20 cents, finally broke out on this news that, India is just not going to be there to supply this exports that the market was counting on. And we made a quick move to 24, 25 cents. Certainly the market's not going to go straight up forever. There'll be corrections along the way. But overall, I see the pattern being very bullish for an extended. I don't see anything that's going to change that trajectory with El Nino arriving and coming. And remember, Thailand is already developing drought pattern already. And so it's a market that after being sleepy for a couple of years is waking up. And I think that the highs that we hit back in the 2000s was 35 cents or something like that. If you look at relative value of sugar relative to overall commodities, if it were to trade at a historic overvaluation, we would find ourselves in that, 30 or 35 cents. I mean, not right away, but I just think this is a market that if you're a physical buyer of sugar, you want to be looking to buy every break that comes along your way. With the tightness that we currently have, and with the El Nino pattern, it's not likely to allow this tightness to be alleviated until either demand is hurt, or, of course, India could decide to stop converting sugar to ethanol. I can't predict that, but right now the situation looks pretty solid. Remember, Europe had a very, 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 very poor sugar beet crop last year because of the historic drought that they had, and so they're short sugar. So you just put all this together, and it's an interesting market that I think it might be ready for a temporary top and maybe a setback, but longer term, I just think buyers need to be protecting upside price risks as we go forward. I don't think we can be assured of a major top until we trade a really poor India crop due to El Nino, and obviously we haven't even gotten there yet. So,
okay, let's jump over and talk about coffee. So you spent a lot of time looking at coffee, and coffee has some pretty good indicators to the overall market as a whole. You've talked about that before on the podcast. If you go back to the end of March, had a set a bottom there about $1.70, and right now we're trading at about $1.96. So in the last couple of weeks, we've seen 25 cents get added back to that coffee market. A couple things. One is the drought situation in southern Brazil and over in Argentina, is that having an effect on what we see happening in the coffee market right now, or what are some of the driving factors there that you're seeing in the coffee market?
No, coffee's too far north.
Too far north. Okay.
Yeah, they're actually, the weather's been pretty good. Crop looks like it's going to be okay. There is some talk, and there is some strong teleconnections that support a very wet weather pattern developing here later on in April into May, maybe even into June. We have very, very hot eastern-based Pacific sea surface temperatures that, but we don't have El Nino in the center of Pacific, as we talked about the other day, and that tends to lead to a kind of an atmospheric river pattern for central Brazil, which is where the coffee is. But we're getting ready to harvest the coffee, so we don't want rainfall now. We want it to stop. And when we have very, very tight supplies because of the frost and the drought that we had the last several years. So the market can't, they need an early, fast harvest to bring those fresh supplies in so that the market can get restocked. And if this very wet weather delays or pushes out harvest and slows it down and delays when those available supplies are going to be available, you get yourself a supply pinch, which looks like the market's getting concerned about. You look at the future spreads, Casey, the nearby prices are gaining on the deferred prices. That's showing a tightness in the spot price. We look at certified stocks after rising for a while, have fallen almost 100,000 bags, are now down to 720,000 bags, down from 880,000 bags a few months ago. and that's your stock of last resort. And when you start pulling back or pulling down those certified stocks. So I think this is just concerning the market that, at a time of really, really tight supplies, that anything that is beyond perfection with the harvest, some buyers are starting to blink here a little bit, and we're starting to get some kind of that supply squeeze trade that we were getting late last year before we got some alleviation of that, of that stress. So in the short run, it's a market that, so long as those heavy rainfall forecasts remain intact, I think there's risk to the upside here for the market to get themselves for the buyers, the physical buyers, to get into a better position to weather a delayed harvest and maybe delayed arrival of supplies.
Right on. Okay. Well, good stuff as usual, Shawn. Folks want to reach out to you and get more information about what it is you're doing over at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. Our Twitter page is at Faradex11, and our LinkedIn page is Shawn Hackett or Hackett Financial Advisors. And from time to time, we'll put interviews with you or with Market to Market, which will be on here a week from Friday, and some other interviews that we do and some other posts we do on Bar Chart that kind of go over some of these cycles, and from time to time to keep you up to date with what's going on with them and where things might be heading. So,
well, Shawn, I really appreciate you being on the podcast, man.
Always a pleasure, Casey. Always a pleasure.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and see the video version over at the YouTube channel, Moving Iron Podcast. Moving Iron Podcast is also on movingironllc.com. Check it out there, and everything else related to the Moving Iron podcast, Moving Iron blog, as well as the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. If you're interested in attending that, be one of the first 150 people to sign up, and Axon Tire takes care of that first $50 for you on that registration fee. Also, if you need more information about what's going on there, you can send me an email at movingironpodcast at movingironpodcast.com, and I will be sure to get back to you with whatever questions you got there. So with that, I'm Casey Seymour, Shawn Hackett from the Smart Folks, out.
Moving iron in the 21st century.